Hey Chris, welcome back to the
What's
Finance
going
Geek
on?
channel. Appreciate you being here. Today we're going to do a little bit of a deep dive on the whole life insurance space, specifically in the infinite banking world. I want to share with you and the audience some of the most popular whole life strategies that exist to help people build their wealth, create financial
Yeah.
independence, freedom, or add to it in their
Yep.
portfolio. And I want to get your take on some of these different strategies. You know, you could pick a favorite or I dislike this, and really take
Sure.
it apart is what I want you to do today, because I think there is a lot of really good people with good intentions, including myself. So I'm putting myself
Yep.
in the hot seat, that get into this space and we get influenced by some pretty charismatic people. Honestly, tell you the truth, pretty
Yeah.
charismatic
Yeah.
people. And then when it comes into actual implementation with the customer,
Mm.
there is a disconnect. I can honestly say if you're someone that is highly skilled in financial literacy, you know more than the average person, then some of these strategies can come pretty easier. It's like, oh yeah, it's simple, boom, bam, done. Let's have fun. But when you're dealing with everyday average American salary between, 60, 80K, maybe even higher, 100, 150K,
Yeah.
there is this long education gap on top of just understanding whole life, and then you
Yep.
need to throw on the strategy that comes with it. And I'm now approaching my 7th year in the life insurance space, and I've
Yep.
made a lot of tweaks. I've made a lot of improvements along the way, a lot of good partnerships like yourself with Life
Yep.
180. And the tweaks that I've made over the years have been in the direction of simplicity over complexity.
Yep.
Even
Totally.
even if even if on paper it comes at a cost of some kind of performance, let's say.
Love it.
I'm
Yep.
I'm I'm seeing the conversations with the client is so much easier. I don't have to dive as deep. I can stay on the materials, what a whole life is, how it works, and all the benefits that it has.
For sure.
But when it gets into the strategy, for me, my head is like, I get it. It's simple. And some
Hmm.
clients, it's simple too. They're off to the
Totally.
races. But there is a good group of people that they're like, I'm not getting it. And then what happens is 2, 3, 4 years later, the value of the product starts to dilute because it's not maybe doing something they wanted, or they simply forgot how to use it, honestly.
Yeah.
I just had a conversation with a client that was like, wait, so when I borrow, I'm still earning interest. So when I take a loan,
Yeah.
it's not the same as being in debt to a lender. You get to set the terms, and I
Yeah.
was having to like re-educate this client of mine, and I was like, oh
Hmm.
my goodness, thank God, like I have ongoing coaching with clients. But had I
Totally.
been disconnected with her for like say 2, 3 years, and she's sitting on this asset that could have been better used of in a certain situation, you
Totally.
know. So that's kind of where I'm at. So I'm gonna take it to the
Love it,
whiteboard.
man.
Unless
Love
you
it.
have anything you'd like to add, I'm going to take it to the whiteboard.
Yeah. Yeah. I'll say this is like what you just said there is one of the most important reasons that people need to really start implementing these strategies right away. Like, if you buy a policy and you start utilizing whole life insurance as part of your strategy, and then you wait 4 years, because and listen, sometimes you have to wait 4 years, right? Because you're capitalizing the policy. Maybe you're doing it because you want to utilize it for a real estate investment or something of that nature, and you're like, I just don't have any capital right now, and I gotta save up. Well, it's making sure that you're checking in. So it's amazing that you have this coaching program because you got to check in and be intentional about like, why am I doing this? And I
Yep.
feel like it's the people that buy them thinking that the product is going to be the solution to their problems, and that's just not the case. It's part of a strategy, right? And there's lots of different strategies that we can utilize with this product, but the key to all the strategies is not the product, it's you. The product is just a leverage piece, right, to it that allows you to increase the efficiency in everything that you're doing. But make no mistake about it, you're not going to create wealth with whole life unless you die, right? You're going to create wealth outside of the policy. Whole life insurance is simply going to help you increase your efficiency in getting where you want to go. Like that's it, like simplistically.
Yeah.
And so I'm excited to see what you have to show.
Cool. All right. So I'm gonna start at the top here,
Yeah.
and then I also labeled the different groups. I would say
Yeah.
that preach what I'm sharing here probably the
Okay.
most. So
Okay.
I started with, like, in my opinion, of like most popular, and then I kind of worked my way down to least popular. So the
Okay.
first is, and when I use the word save money, that's referring, for those listening, that's referring to you parking your money that you're saving, this leftover dollars that you have, and you're
Yeah.
contributing to a whole life policy. So all of
Yep.
this, part one is putting money into a whole life, and step two is you borrow
Yep.
out of the whole life, the cash value part, and you're going to finance consumer purchases such as a car. I would say the
Mm-hmm.
car example is probably one of the most popular, most
Sure.
viral videos in the infinite banking
And
whole life space. Would you?
and most misrepresented.
And most misrepresented, correct, in
Yep.
in that sense. And it sounds phenomenal on paper, because, and I'm coming from personal experience, like I actually did that
Yep.
and saw, I see what the content creator, what the insurance agent is saying. Like, I get it, where it's like, hey, you're gonna spend money anyways on
Mm-hmm.
this product, on this consumer item. You might as well park that money in your whole life first, so you can earn some interest for the rest of your life on those dollars. And then
Sure.
when you borrow, the financing cost of that is going to be competitive, maybe even
Totally.
beat what you would get at a
Totally.
car dealership. Totally get that.
Yep.
The conversation that gets missed, and someone like Kim Butler and Tom Langford, and even someone like yourself
Yep.
and Garrett Gunderson and Caleb,
Yep.
would say, what about the opportunity cost, time value of money, of
Totally.
you doing something else with those dollars?
Right.
Right. So that's where I had like my light bulb moment, like, oh yeah, got it. That makes sense. So the become your own banker community, I think, preaches this the most, where you're saving money, you're building, you're capitalizing the policy, eventually borrow, and you're going to either finance consumer purchases or even expenses, such as a tax bill, financing a
Sure.
tax bill through here, like a large tax bill, or some kind of vacations, right? You name it. And again, it's something that I've done personally. I financed big items in the early days of my policy, and I financed a car once, and I ran expenses. I took it to the next level, Chris, where I was like, because the math wasn't fully mathing for me.
Sure.
So I took it to the next level. I was like, okay, what if I parked that money in the policy, but before I immediately pulled it out, I'm going to use a 0% credit card with cashback rewards for 21, 24 months, and get a statement credit of 2, 3, 4, $500, and sort of create a little arbitrage there. I'm gonna change my monthly bills to annual and save money on the bill itself, like my car insurance. If I paid in full, I save 5% or 10% off the
Yeah.
bill itself. So
Yeah.
here I am saving 5 to 10% or more on the bill itself, getting 2, 3% cash back, getting a statement credit, doing all of this. And when I looked at the numbers over a period of time, what happens is the returns diminish over time. If you do it one time and stop, you would yield a good result, but still pales in comparison to the opportunity cost conversation. What could I
Mm-hmm.
have done with that money, maybe elsewhere,
Yeah.
with that policy? So
Yeah.
when it comes to that, the first one, what are your thoughts? Where do you think this all
Huh.
started from originally, and how did it pick up so much steam over the years and
Oh
still is?
man. It's because people are focused on marketing and not educating, and this is the problem. I've always said I want my channel to be about education and not marketing. I don't want to be a marketer, a financial marketer. I want to be a financial educator. And that's one of the reasons that I resonate with you so much, is that you're seeking like real true education constantly, and you're looking to share that with people. And so, I don't know where it started. I mean, I think what happened, and all this has gotten way worse since Nelson Nash died. I don't know if you've noticed that, but like
I agree.
when Nelson Nash passed away, and he is the guy that created the infinite banking concept. It's like the foxes started running the hen house. You know what I mean? And like all the agents out there started misrepresenting what all this is. Now, here's what I say. This is one of the reasons that I love whole life insurance so much as a foundational tool or foundational asset to what we're doing, is that when we look at personal finance, we got to think about opportunity cost, we got to think about time value of money, and we got to think about cost of capital, right? These are the things that successful people understand. If you're running a business, if you're doing real estate investing, if you're doing anything at a significantly high level, understanding opportunity cost, time value of money, and cost of capital are the three most important things. And the reason I say that is because those are the elements of your personal financial life, of your business life, or whatever, any all money that flows through your financial ecosystem as an individual or business. Those are the three biggest variables, because it impacts every single dollar that flows through your life. And one of the things that people look at is they say, well, I guess one of the things that financial salespeople will try to convince people is that you got to just think about the interest rate or the rate of return, or whatever. And the bottom line is that's kind of just, well, it's only a half truth, right? Because it's absolutely interest rates and rate of return. I'm not saying that they're not important, but
Yeah.
they're certainly not the most important, right? And that's where people get lost, is what people are focused on the wrong things. That's the reality. And so what we need to do is we need to be focused on the right things, and that is opportunity cost, cost of capital, and time value of money. And so when we look at, like, say, buying a car, okay, let's go back to that example. You got a lot of these influencers online trying to position it like you can make money on every car you buy, right? You've seen those videos.
Yeah.
And the challenge with that dialogue is that if you're a person making 80 grand a year and you're like, all right, I'm going to go buy a minivan for my family because it's economical, it's this, it's that, whatever. And it's $40,000, and that's still a stretch, but like I need it for my lifestyle, I need it, whatever. And so I got this lifestyle expense of this depreciating asset, which is it is what it is, right? Like you're going to have an expense that goes along with that, right? That you can't avoid it. And so I'm not one of these guys that's going to try to convince everybody to live a smaller life and
Right.
not do the nice things, and whatever. Don't buy a nice car. Like I think I think lifestyle is important, right? And like and you want to set your life up to be able to live now at the same time while planning for your future. I think that's really important. And I think the danger with the way that infinite banking and whole life insurance as an asset is being pitched by the majority of people online, not everybody, but by the majority, the danger is they're saying, you know what? You can make money. Why go buy that car? Why go buy that minivan in this way? Because you could use infinite banking, flow your money through your whole life policy, and I'm going to show you how you can actually make money on buying that car. That's just not the truth. And so the danger in that conversation is, well, shoot, if I can make money on buying the car, why not just buy an Escalade? You know what I mean? And so then the person, instead of buying the $40,000 minivan, goes and buys an $80,000 Escalade, thinking, well, if I'm going to make money on this thing anyway in the long run, why not do it? But here's where it comes back to. It doesn't work that way. And so what we need to be thinking is, by having the whole life insurance policy, it allows you to be a better consumer. It allows you to be a more empowered consumer, right? And it gives you more control. And the more you start to understand opportunity cost, time value of money, and cost of capital, the more you understand the value of whole life insurance. And this will go, how do I pay off debt? How do I buy a car? How do I finance investment properties? How do I do? all these things. You start to understand that every single purchase you make, you're financing. If you pay cash for it, you're losing the ability to earn interest on the cash that you paid for it. So what is the opportunity cost on that? What is the time value of money of that cost of paying cash? If you are financing it, well, obviously you're paying interest, and you always have to dissect and evaluate what is the opportunity cost, what is the time value of money, and what is the cost of capital. And the cost of capital is the one that most people are not talking about, but it's one of the most important elements of it, because by having this asset, I could go buy right now. Like, listen, I could go buy, like, I've got my I just showed you before we went live. We just bought this mobile headquarters for Life 180. Right, I'm on the road. I'm in Utah right now. We're doing this thing. We bought this trailer. It's like $40,000, right? Like, whatever it is. And we got a good deal on it. But we went through and we're looking at it. The cost of capital to buy this trailer with a good credit score was over 15% interest in today's market. Think about that, right?
Oh, wow.
So if I were to finance that through the bank completely and keep it that way forever, I'd be paying 15.99% interest. And now, from a lifestyle perspective, I want to have it, right? Like I'm gonna be able to utilize it as an investment. I travel a lot, I speak a lot. Like, this is just a lifestyle thing that we've decided to do for our business, and like kind of blending everything together. That said, now I can look at refinancing that through the policy, right? And now I'm paying 5.5% interest, right? But while I'm paying the 5.5% interest, my money is still growing in my policy. Let's say my money is growing in my policy by 4% a year. Okay. People get it wrong. Infinite banking, whole life insurance, it's not about having positive arbitrage. Now, there are instances where you can, like you kind of said, you can create positive arbitrage situations. But once again, that's not based on the fact that that's what whole life insurance is about. That's based on your creativity, right? Your ability to find other avenues and assets and 0% credit cards and kind of laddering and layering things together. That's a different story. But that's the thing, because you had the asset of whole life insurance, you could go do something like that, right?
Mhm.
And then you have to kind of like do the math and figure it out, right? And is it really working that way? But here's the deal. If we know we have to buy these assets, I knew I was going to buy this trailer no matter what, right? Like, this is a lifestyle thing. It's a business strategy thing. There are costs and expense that come with that. To think I'm going to just make money on this is a whole different scenario. That's not the conversation. The conversation is, if I'm going to buy this anyway, how do I maximize my opportunity cost personally? How do I maximize the time value of money and reduce the cost of capital as much as possible to enhance those first two things? That's what it comes down to. Does that make sense?
It does.
And so,
It does.
so if I can say, well, right now my cost, if I were to finance it like the average everyday American, is going to cost me 15.99%. If I could reduce that, refinance it through a whole life policy, pay 5.5% while earning, 4%. Well, now my net cost to borrow on this is the 5.5 minus the 4, which is 1.5%. I'm still spending money. I'm not making money on this trailer, but I've recaptured and recaptured the money that I'd be spending on the interest rate on all that, and I've recaptured the opportunity cost, because if I paid cash for it, well, that cash could earn, let's just call it 4%, 5%. It doesn't matter. That opportunity cost would earn 5%, right? So if I go 5% minus 1.5%, which is my cost now, my net cost of paying for this trailer, right? Now I've really maximized everything, right? I've got the trailer, I'm spending the 1.5%, and I'm earning the 3.5% net at the end of the day inside the policy, because it's still growing. A lot of people, when you look at it on a spreadsheet, that doesn't seem super sexy. You know what I mean? And so what happens is, infinite banking people just want to be like, you're making money on everything you buy because of that 3.5%. They're trying to position it like that. But the problem when you position it like that is it makes a lot of sales of policies, but you got a lot of people that don't really understand all the moving parts and the variables that actually matter. And so then you got behavioral issues, consumer behavior issues, and emotional decisions that are made without the logic and the technicals to back it up, that will actually impact your decision-making process, so you understand what you're actually doing. And that's a big big part of it.
Exactly.
Is that all
That
kind of compute?
that really does, because it, and to kind of wrap that, it's again, we're you're getting part of the truth, where
Yeah,
you can make the argument that you are making money and it's tax-free growth and you're getting this positive arbitrage split. No doubt
yeah,
about that. We're not arguing against that. It's just the results pale in
totally,
comparison to you keeping the financing with the bank. Let's say in that same example,
for sure.
Chris holding on to his capital, and maybe there's a much larger opportunity at stake for Chris that he could take while still
Mhm.
having the trailer and getting the full
Totally.
experience of the trailer. And you can also argue that by him not paying in cash for that entire trailer all at once, there's
Hmm.
also less risk on his end. If the trailer breaks down, he catches a flat, it's less money he has to come out of pocket to
Totally.
handle some of the ongoing expense, the lifestyle expense that comes with that. So I think that's very, very helpful for people to see both sides
Mhm.
and to really help you watching to make the best decision. At the end of the day, people are still going to do this. I already recognize that. I have plenty of clients. I get clients from different insurance agencies that
Yeah.
come to me
Yep.
after they've had their policy in place 2, 3, 4 years,
Yeah.
simply because they need coaching, and the agent may not provide that kind of an ongoing coaching service unless they get more policies and then there's a little more activity going on.
Yeah.
But clients come to me with 2, 3, 4 policies and they're like, I just know to save in here,
Yeah.
and I have cash value here, I've got some loans here going on. And the last thing that I'll put a bow on this, what I've seen coming from my perspective as an agent that has been able to successfully sell quite a bit of life insurance over the years, I think the returns that the agent is getting and the increase in income that the agent is getting over time gets so clouded that whatever the agent is doing inside of his or her policy, like financing cars and whatever the case may be,
Yep.
looks phenomenal simply because we have so much revenue coming in to sort of like mask the actual return on that single transaction. That's something that I had
Yeah.
to learn and see, or where I was like, wait a second,
Yeah.
if I'm preaching this, but I'm also the one benefiting from the
Yeah.
transaction of each and every one of those sales, I'll never lose. Like I'm gonna have all this gain because I get the
Yeah.
commissions talking
Yeah.
about it. I'm
Exactly.
monetized on YouTube.
Totally.
I've got partnerships, but my clients don't have those other elements. If one
Right.
aspect goes wrong, it can it can really limit the amount of available capital that they have inside of
For
the
sure.
policy when life does happen. So I've over the years I simply shifted, and I still will have clients that do it, but I'm like, hey, can we also make sure that we still have 6 plus 12 months of
Yep.
savings in that policy or off to the side somewhere, additional money here to kind of hedge in case anything goes wrong, yada yada.
Yeah.
So, okay,
Yeah.
cool.
I look at it. I look at it like this: is like the most important element of it at all is control. Right? It is literally just, are you who you need to be to understand all these different moving parts? Do you have the control to make the decisions and the flexibility? And really having a whole life insurance policy is empowerment. I mean, and listen, it's complicated. Like, I still have my wife come up to me sometimes and be like, "Hey, shouldn't we just use the policy for this?" You know, and and I'm like, "No, actually, this is not a scenario where utilizing the policy actually makes sense." And she's like, "Well, that's what you preach all the time." And I'm like, "No, it's not. You know, like." It's not always use the policy for everything and eliminate all banks and all this stuff. And that's my big problem with infinite banking is their whole philosophy is like eliminate the banks, and it's just a little too far right wingy, like,
I agree.
intense for me. Like, it's like, why would I want to eliminate the banks if I could increase my efficiency with the banks? Like, and it's a little too political for my taste.
I
So
agree. I agree.
that's just okay.
Cool. All right. So I appreciate that. That's very good. I want to keep kind of going down the list here and get your feedback
All right,
on some
let's
other
do it.
things here. So this one's a little more simpler, and this is one I've bought into personally, have done, and I
Yeah,
think it definitely has its place. And there's scenarios where I think it absolutely makes sense. But the
yeah,
simple one is just save money in your whole life, money you
yep.
cash flow a certain amount to eventually borrow, to eventually pay off higher interest debt than what your loan interest rate would be in the policy. About as simple as that. And then the cash flow that you recover, you start to pay back that loan. So you're reducing the interest cost even further on it. What's your thought on just that? Simple, straightforward,
I love this. So I think this is one of another overly sold
overly
processes
sold?
online,
Okay.
and it's not that I don't like it. There are instances, like again, it's always compared to what. That's what we always have to be thinking.
Yeah.
There are instances where I think utilizing whole life insurance to pay off debt is wildly amazing, right? Like, but it always depends on what type of debt it is, where the debt is, what your cash flow is like, how much liquid capital you have in different accounts. I'm a big fan of refinancing debt into a policy, right? So when we refinance the debt into a policy, that looks like something like this. If I got $50,000 of credit card debt or consumer debt, what I would call, consumptive debt, right? Like I look at debt in two ways: productive and consumptive. Like it's either increasing your capacity to create wealth because you're utilizing debt as leverage, and debt always comes with risk when we're doing it for that. But your productive debt, you're looking to utilize debt for creating wealth, and consumption debt is more lifestyle debt. Like this is the consumption debt would be financing a car, would be going on vacations, would be, slapping a vacation on a credit card. Like that's consumption debt, like that kind of stuff.
Yeah.
Productive
Somewhat
debt,
constructive.
creative debt is saying, hey, I'm going to take a loan on an investment property, like whatever. And that's like, all right, it is what it is. You got an asset behind it. You've got cash flow behind it, like all these different things. And you got to learn how to manage it all. But like getting back to the point is, if you got $50,000 of credit card debt and maybe high interest debt, like a personal loan or something like that, in the 10, 12, 15, 18, 20% range, which happens, it's shockingly all the time. It's like the challenge is, if I'm saving in a whole life policy, like, and this is the challenge. I looked at this the other day where somebody was like, I'm going to take your 30 years it's going to take you to pay off your debt. And they include the mortgage, they include all this stuff. And they're like, we're going to pay it off in 11 years. And it's like, I looked at it and I'm talking to this guy and he's trying to sell me, right, that this is the way it works. And I'm like, is it though? Because when you get to be 11 years, you still have debt. The debt is just in the policy loan, right?
They
And
forget
so are
that.
you really debt free? Are you really debt free? And so, and it's used, once again, it's used as this marketing tactic, right? Now, I'm not saying it's bad, right? Like, I'm not saying this situation wasn't bad, but, or was bad. It could still be a positive outcome from a
Yeah.
math perspective, from a long-term perspective, right?
Mhm.
And it may have still been in alignment with what they were trying to do from a long-term perspective and more efficient than what they were currently doing. My problem comes in, like, tell the whole story. Don't market this as if they're going to be debt free at year 11, because they're not. They've just simply refinanced their debt into their policy. And if they don't really understand that and wrap what their expectations of themselves are, and the human behavior and the consumer behavior and the investor behavior and savings behavior and all these different things, well, then they're going to get to year 11 and their whole financial life is going to be jacked up because their expectations are out of alignment. You know what I mean? And so that's my problem with this kind of stuff. Now, so I am also, I'll say this, like, if you got 20% interest debt, like, the thing that I don't like is when people say, all right, you're paying $1,000 a month, so let's just take that $1,000 a month and flow it through the whole life policy and then pay off, take a loan from the policy every month to pay off the debt.
Hold on, we're gonna get there. We're gonna get there.
Okay. All right.
Because
All right.
I got that on the next one
You got
here.
that. So like, then we'll go there then in a minute. What I will
Yeah.
say that I do like, I'll talk about what I do like then,
Okay.
is when, if you have a bunch of debt and then you have a bunch of savings or investments. I'm a big believer in changing human behavior and utilizing these assets that you have to increase your financial efficiency, putting that money into a policy, borrowing against that policy, refinancing the high interest debt into a lower interest debt environment. But let's be real, you do this probably more than I do as far as dealing with these sorts of situations due to the nature of your content, your channel, and how you serve people. Most people that got $50,000 in credit card debt aren't sitting on a pile of money somewhere else. Like, they got different challenges, right?
Correct. So the and I'll close out saying that there's, again, you're not totally against the idea of funding a policy, borrowing against it eventually to pay off some non-productive debt that's costing you a
Right.
lot of cash flow, and you refinancing the policy over a long period of time, you end up paying far less in interest
Yeah.
costs. But you can still, they're still looking at the full entire picture of like, okay, yeah, now that the debt's gone, but also run the math on how long is it going to take to actually pay off the loan. And oftentimes that math gets taken out of context. It gets
Yeah.
just forgotten about. And then you
Yep.
also have to keep in mind that you're still funding the policy. You still need to fund that policy. What are we doing with the extra cash flow? So
Yep.
there's where I've worked with clients on this in that case is when we've already established a pretty good foundation, because majority of people I work with have no foundation, have no life insurance, no whole life, tons of debt, 6-figure plus debt, and we're using other debt elimination methods that don't involve a whole nother product like whole life out the gate.
Yep.
And once they've really built some strong positive cash flow, 1,000, 1,500 or more, then we start to look at, okay, what would it look like to start saving money while still getting out of debt and running the full
Yep.
math on it. So yeah, my practice has, I've been that guy that just told one part of the story simply because
Yep.
I was told one part of the story and it made perfect sense. And then over
Yep.
the years, it was like, wait, there's more to the story. And it's
Totally.
actually really exciting when you get the client to see the full story at hand. So,
And isn't that the part though, Denzel? Isn't that the cool part? Is like, people are telling half the story to try to make it hyped into something that it's not, and they're creating confusion and they're misleading people. Whereas if you actually empowered people with the whole story and let people actually take accountability for the whole situation, they're going to be more excited, because what we do
yeah,
and the power of it is so powerful and so impactful. Like, it's some of this stuff, like with the cars and the debt, like, which are the two most common areas where people are misrepresenting how this works. If you would just tell the truth, it's better than what you're selling, but it's like you don't have confidence in yourself to have the whole story. I think
agree.
that's
I was that guy. Early on in my YouTube years, like I definitely like
yeah,
if you go back, you see case studies, like I mapped this stuff out. It looked amazing, and I mean, it was like people
yeah,
did get results in a sense, but I also didn't
yeah,
know the rest of the story that was at
right,
play. Where
yeah,
now I'm still doing, sometimes some cases involve paying off debt using a policy, but
uh-huh,
I'm also telling the full story where I'm like, hey,
perfect,
we're in a unique position here where we have options. That's kind of how I present it now with the client, where I'm like, hey, we could totally use this policy, pay off debt, and we'll save money on interest, and we'll cash flow, and we'll make some net positive arbitrage, and we could show the math for that.
yeah,
But you're also in a position where you've got almost 6 figures in this policy built.
mhm,
What if we started increasing your knowledge on your investor DNA? And let's figure out a little bit more about who you are as an individual and how you can create more value in the marketplace and use your
that's
whole
what's up.
life as a hedge. What's the
That's it.
math behind? And so
That's it.
sometimes the client will say, "I'm not ready, Denzel.
Right.
I'm too scared. I'm not ready yet." At
But
least
that's
I heard that, you know.
that's the key though. What you just said there is, you're not now pushing your agenda to get them to do something. You're being a financial guide that's helping walk them down a path for their own journey of self-awareness, and you're trying to help them create alignment in their life, right? So they can be a better consumer, a better investor, you know, a more educated individual when it comes to personal finances. Like,
Yes.
and That's the empowerment. You're empowering them through creating alignment through this education. And that's the key. None of this is good or bad. Is it aligned or is it misaligned
Yeah,
with what I'm trying to do? And
absolutely.
that's the key.
I love it. So the next one here, which you were diving into, I'm actually going to skip over this one, the third one. We're going to
Okay.
the fourth one. And this
Yeah.
is saving your money in a whole
Yeah.
life, the cash flow
Yeah.
you have, plus the debt payment that you have on a debt. Let's say you're cash flowing $1,000 and you
Mm-hmm.
have $750 of debt payments. So what you're
Mm-hmm.
actually going to do is you're going to fund a whole life contributing the whole 1750, and then literally within 30 days or less possibly, you're immediately taking a loan out for 750 and maybe a little bit more from that initial 1,000 of your cash flow, and
Sure.
you're gonna pay down your debt over time. So you're gonna pay your debt payments plus extra goes to principal, and this is the bank on yourself community
Yeah.
that preaches this a lot. And
Yeah.
I've personally seen people self-destruct with this
The worst.
because you are slowly creating a large group of loans in one
Mm-hmm.
policy, and depending on the type of debt that you have and the speed at which it gets paid off,
Uh-huh.
there you could absolutely show on paper, for sure. You can absolutely show on paper that it'll work. Here's the problem though. What if the dividends in the whole life don't perform as well as the illustration, or it goes down, or what if life happens to the client?
Yeah.
Just life. And here's
Yeah.
the
Yeah.
other thing is you're creating like multiple manual steps for the client where they have
Yeah.
to intentionally set up auto pay of the 1,000, plus they have to strategically get the 750 in there. And let's say that 750 is 3 4 debts. They have to strategically make payments into their policy before the due date and then request the loan before the due date to avoid
Yeah.
late fees. And so you were about to, pop off on those that do this in a sense. So what's your take on the community that's preaching this, and
Well,
is there
it
room
all comes
for
down.
is there room for improvement? Is there a way to frame the conversation differently, not to bash these people, because I do believe they have good intentions, and I sat through in a presentation, I'm like, this would convince any one of my clients that don't have the level of financial literacy and the capacity to think about the whole picture. And so I can see why even I myself would buy into this. And but if you dig, deeper into it,
Yeah.
you're it's like you're trying to build a farm or lay seed out with the smallest tools in the shed instead of the biggest, most efficient tool to lay out
Yeah.
the soil and to
Well,
plant the seed. It's like you're using your bare hands, let's just say, to
well,
try to make this happen instead of
yeah.
using
Well,
the proper tools.
totally. The argument for the people that believe in this concept is the fact that, like, all right, if I got the 1750, I'm going to borrow. Let's call it 1250. I'm going to borrow every month, right? Against it, and I'm going to pay debt down. The problem is if we go do the 1250 versus the 1750, because let's make no mistake about it, like what most of the people are doing are saying, well, right now you're paying 750 down towards your debt, and you got this extra 1,000 that you're saving. So let's take the 1750, put it in the policy, borrow 1250 against it, and now you're paying that 1250 down. It's going to make the debt pay down look better because you got an extra $500 a month going towards the debt pay down. But that you're not comparing. Remember, it's always compared to what? You're not comparing the cash flow properly, because if you were to, what you really need to do is look at what would it look like to pay down your debt at 1750 a month, and
Like
do all
just
that, because
straight.
you got just straight, right? Because there's that extra $500 that you're putting in the policy. That listen, this is a long-term strategy. There is a cost of insurance, there are admin fees, there are all these things, and from a long-term perspective, it's amazing. And the one of the biggest risks that you have in these policies is getting the policies, taking loans immediately, or virtually immediately. And when I say immediately, I basically mean first year, second year, or in that range, and not having a plan to pay those loans back anytime soon, right?
Correct.
And that's where these things blow up all the time. That's where infinite banking, bank on yourself, whatever, falls apart. That's the only way it doesn't work. Okay. Like, quite frankly, is when you start borrowing against these things virtually immediately and not having a plan to pay the loans back or to manage the interest expense on those loans. And I know everybody likes to say whole life insurance has simple interest, life insurance has simple interest, but that simple interest is annual and that does compound over time if you don't pay it back. And that can cause tons of problems. So what we have to do is go back to what I was saying before: opportunity cost, cost of capital, and time value of money. So when we look at this, it's like, if you have 18.99% credit card interest, right, which is a pretty common number for a lot of people, if that's what you have to look at the opportunity cost. Instead of that $1,750, paying the $1,250, what's the opportunity cost on that $500 a month at 18.99%, right? And, it's just a matter of doing the math. You know what I mean? But once again, people will go back to this and be like, oh, your credit card debt is paid off so fast. Look how amazing this is. But they ignore the loan balance sitting in the policy, right? And so when you do that, I think it's important if you are a consumer that's looking at doing this, make sure that the math checks out after looking at the loan balance inside of the policy. When they tell you you're debt free, check in and say, all right, what's the calculated loan balance inside of the policy? And you can run illustrations with the loans pulled out, showing you what it looks like with today's current assumptions of where the dividends are and so on and so forth, which I think, with dividend rates being as low as they are, I think is pretty safe to do at this point in time. But you still have to do that. And so I'm not a fan typically of that in this. So my philosophy in this instance would be: buy your net worth, build your cash flow. I'm really big. Life insurance is what we do, right? So like life insurance first, buy your potential net worth, get a term policy that's convertible, lock in your ability to do this long term, spend 30, 40, 50 bucks a month on a couple $1 million term policy if you're 35 or so, something like that. And obviously you got to look if you're older. Like, I just bought a $2 million term policy last year at 44 years old. It cost me like $1,600 a year. Like, so do that, do that and have it be convertible, but then take the extra cash flow you do out of that $1,750 and just jam it towards paying that debt down. Once the debt's paid down, now start converting the insurance that you have to a banking style policy, the banking alternative policy. That's kind of the way I would handle it.
Yeah. Thank you. Okay. So the next one, coming back to the third one here, and this is less popular and one that I gravitated to once I tested out financing consumer purchases and expenses, because that's literally how I started my first policy, is by Nelson Nash, Become Your Own Banker, with a different policy design. I didn't go with the way they designed the policy. But I went with how they used their policies. And then I, kept searching more content, and then it was, okay, what if I just save money, invest, or save money plus park investment dollars that I was going to send to an investment anyway, but I'm going to park it in the whole life first. I'm going to borrow out the investment part, right? So let's, keep it easy. $1,000 for saving and say $1,000 for investment. And I'm going to take that $1,000 and borrow it back out at an interest rate, and I'm going to invest and try to create cash flow, which ultimately is the famous words, the positive arbitrage that would occur. Let me get your thoughts. On this one.
Sure. So the idea of that positive arbitrage, you're not really creating positive arbitrage, and that's the myth. So the idea there is, and I hear this all the time, the idea there is, I'm gonna keep numbers really simple here, just for listeners, right? Even though these are not the exact numbers, so that's the full caveat here. But the idea, the philosophy, the way that it's sold is, all right, go put your money in a whole life policy. You get a 6% dividend rate. You could borrow against it at 5%, right? So I'm going to put $1,000 in. I'm going to borrow 1,000, assuming that you got the cash in there, right?
Mm-hmm.
And so I'm going to borrow at 5%. All the while, my policy is going to be making 6%, right? So I'm going to earn that 1%, and then I'm going to invest in whatever I'm investing in, right? Like, and let's call it I'm day trading. I'm day trading, and I'm earning 15%, right? So the idea is like I'm going to borrow at 5, earn 6. The money I'm using to borrow, I'm going to earn 15 on with my day trading, whatever it is, my currency, forex trading, whatever. And so therefore, I'm that positive arbitrage is I'm just creating more leverage, right? Like in this by utilizing the policy. But the reality is that's not how it works. It's this is where it goes back to the important parts. Like when we focus on arbitrage being the secret, you get in trouble.
Yes.
And you start looking as time going down the road and the math doesn't math, as you said earlier. And you're like, and this is where this stuff gets a bad reputation and it pisses me off because it shouldn't. Like, this is so amazing in what we can do. And if you utilize it the right way and understand the opportunity cost of capital, and time value of money, and if those are the three metrics that we're looking at, now you start to be like, all right, this can work. But the question is, where does it work? And this is why I created cash flow hacking. I don't want to jump ahead on you because I'm sure you want to go there a little bit, but I got to go there because it's relative to this.
Go there.
It's relative to this. This is why I use cash flow hacking, because real estate creates cash flow and does all these things. Business, right, creates cash flow. But the thing is, these two elements, whether you're buying a business or whether you're buying real estate, they require down payments, right? And those down payments, there's two things. Like, I'm going to use real estate as a focus, okay? So if I'm going to buy a $500,000 or $400,000 investment property, okay? In that $400,000 investment property, you need a 25% down payment, okay? I could go get I could pay cash for that 25% down payment, but then I have to think about what's the opportunity cost? What would that money grow to, right? And or I could go get a second mortgage. You could finance a second mortgage, right? Now, that's higher interest rate debt to be able to do so. And so when you look at the cost of financing an investment property, right now it's 8.5%, 9%, maybe 9.5%. And when you look at financing a second mortgage, you're looking at 11, 12, 13% to do that. And so now you have to think about, all right, from this asset perspective, what's the cash flow? But also, what is the cost of money? Well, the cost of money is 8.5%. The cost of the money is 12%, whatever that is. And so now if I have an asset sitting here, right, in the whole life insurance policy, that I say, well, I could leverage this and borrow against it and do the down payment for the property, that 25%, that $100,000 down payment to buy this investment property at 5.5%, it's not about the positive arbitrage. It's about, compared to what? It's about the cost of capital. Mm-hmm. It's about increasing that efficiency, and you have to run a completely different type of spreadsheet to calculate that, right? Yeah. You have to, compared to what? Like me utilizing a 5.5% down payment, I have to say, all right, what would it look like compared to doing that down payment in cash, right? What would it look like to compare that 5.5% down payment and all the policy loans and everything, the way the whole life policy works from a long-term perspective compared to financing a second mortgage to do that down payment? And when you start looking at it like that in these instances, and you think about opportunity cost of capital, and time value of money, like, this is where whole life insurance wins every single time. And I will put my life on that. You know what I mean? But the thing is, it requires the consumer to take more accountability for the results in their life and to learn these things that actually matter, right? These variables that are actually going to impact the results, instead of just thinking that this magical tool of whole life insurance is going to give you positive arbitrage. And by you putting this money in a policy, your life is just going to change.
Right.
So that's the thing. Everybody's like, change everything just by doing one little thing and flow your money through a policy and everything's going to be better for you. Yes. No.
Yeah. To wrap up that, it's what you're simply asking folks to do as we're going through these different philosophies is ask the question, compared to what?
Yes.
If what happens is a lot of people who have a whole life are just borrowing because they think it's cheaper.
Yep.
in the short term, but not looking at the long term effect and all the side effects and
Yep.
symptoms and consumer behaviors that come with that. So all we're saying is, hey, just if you're gonna do it,
Mm-hmm.
could you at least compare it to what you could have done so that you don't get buyer's
Totally.
remorse 4 or 5 years
100%.
later on this asset? Okay.
An educated decision is an empowered decision, is an
Yep.
aligned decision because you're going to come from a place of alignment. You know, I created the Life 180 Wealth Formula, which is clarity plus alignment equals the life you desire. We need to stop thinking about rate of return, interest rates, all this stuff. Like, all that's important. We'll get there. But you got to
Yep.
first think about what is the life you're trying to create, right? And then go backwards from there and figure out what are the metrics and variables that I need to take into consideration in all of this to actually be able to create that life that I desire, you know? And this is the stuff that we're talking about that literally is going to help you understand the moving parts of money that will help you do it. That's what it's all about.
Absolutely. So coming to the last one here,
Yeah, yeah.
this has become my favorite,
Yeah.
most simplest view here,
Yep.
and I wish I would have saw this 7 years ago, which is you save money,
Mm-hmm.
but you're replacing your
Mm-hmm.
bond portfolio. So the money, when looking at someone's their whole financial picture, you're
Yeah.
actually looking at how much money is this person saving? Where are
Yep.
they saving their money? Are they saving their money in bonds, CDs, high yield savings, money market accounts?
Mm.
And we're just simply going to redirect those dollars to a whole life,
Yeah.
and we're going to position the whole life essentially as a hedge
Yeah.
against everything else you do in life that will produce the major activity of wealth building.
Yeah.
And the result is you increase portfolio success in retirement. You
Mm.
learn about proper sequencing of returns, and you
Yeah.
ultimately end up in a place where you give yourself permission to spend money abundantly,
Yeah.
intentionally. And that is the Tom Wall approach, a book called Permission to Spend.
Yep.
And that's it. Like,
Mm-hmm.
let me get your view on
This is
just on that,
so,
because
so I'm
that
so
right there,
excited.
I had a paradigm shift in the last
Yeah.
year or two when I
Um,
first heard him speak and
amazing.
read his book, and I was like, "Whoa, what's happening here? This is interesting."
We could
So,
do a whole video just on this, and we probably should come back and circle back and do like a full deep dive into the power of this because it's even beyond like. So I'm so first of all, I'm so excited that you are there now and that you see that. Secondly, I would say it's even deeper and better than everything you just said because here's the thing, and this kind of comes back to what I've been saying on all the other things is compared to what, right? And so you know, the reality is everything Tom Wall teaches in the permission to spend typically becomes really relevant for people once you become 50, 55, you're getting close to retirement. You got to think about my bond portfolio. Most people are going to look at bonds. You know, you don't get a lot of 25-year-olds, 35-year-olds investing in bonds because they're like, well, the returns in them are not good. And so the opportunity cost of having my money in bonds compared to being able to get higher returns is just too high. The time value of money, the cost of that opportunity is just not it's not strong enough. So I'm not going to invest in bonds. And the reason people invest in bonds is because they want to take risk off the table in retirement to manage the risk of running out of money in retirement. And there's a lot of math out there that shows the power of this. The reason, and so that's amazing, right? First and foremost, like for those people in that range, that's amazing. For younger people, they start going, well, it doesn't necessarily make sense for me because that opportunity cost. But here's the thing. We have to look beyond the numbers, beyond the rate of return, beyond, the interest rates. What we have to look at is saying, all right, if I want great long-term results, I have to think about long-term thinking, right? And the thing that I love about whole life insurance, and we can't get into it in super depth, but once again, we'll come back and do another video on this, is whole life insurance is the only asset that is going to grow with you through life and solve different problems and be able to pivot with you. So all the things that we've talked about so far, how to finance cars the most efficiently if you're going to do it. I do believe like that buying a car through your whole life policy can be the most efficient thing, right? It might not be, depending on what the interest rate is with
Right.
the
And
auto company.
the season of life
Right,
that you're in, like the
right.
situation, the
Right.
context. No
And what
doubt.
other opportunities may be existing for you, and you have to learn to become the person you need to become to make those decisions and be empowered. The asset being there in the whole life policy is just going to empower you to show up differently in these negotiations, right? When you're sitting down with the finance managers. Like that's the powerful thing there, right? Like so it's not good or bad, but what I do believe is that as you go through life, when you're 25, your needs are different than when you're 35 and 45 and 55 and 65 and all throughout retirement. And so this asset is going to grow with you. So when you're 25, you need to save an emergency fund. You need to save an opportunity fund. You need to be creating and building your foundation. And so you do that, right? And now you have the whole life. It's not about the return in the whole life policy. It's about the financial structure and the process that you're following, right? And who are you becoming in this process? What is your education? Like what is your investor DNA? Are you learning how to create aligned investments with the desired life that you're after? That's what it's all about. So now when you have this whole life policy, let's say you start at 25. Well, you don't really care about having a bond portfolio in retirement at 25. I know I didn't. Most people don't, right? Most people don't have the ability to think 40 years down the road and whatever. They want to know, what can I do right now? But the beautiful part about having a whole life right now is that it's going to solve your emergency fund need. It's going to build into your opportunity fund. It's going to help you be a better real estate investor, a better entrepreneur, a more secure and stable, financial position as you go through life. You can utilize it for all these different things. And when you do it the right way, by the time you get to retirement, you're just going to have this bond alternative sitting there for you that's going to now give you benefits in retirement that if you waited to deal with until you're 55 or 60, there's going to be a massive cost increase in dealing with that. So now when you think about what is the value of doing this, most people are going to be like, well, why would I save money in a whole life policy at 25 and 35 and 45 when, I don't really need this bond alternative? Well, I guess your 65 and 70-year-old self is going to thank you so much
Yep.
because of how much money you saved them that you're not going to be able to calculate right now. You're going to be saving thousands of dollars, not per year, but per month in these costs. And it's going to enhance everything that you're doing in retirement and create a lot more stability, a lot more control, and it's going to increase the leverage in the percentage that you can take out of your investment portfolio from an income perspective. Tom Wall, Dr. Wade Fowle talk about this. By having 7 years of income in a whole life policy when you hit retirement allows you to increase your distribution rate in your investment portfolio by 25 to 50%. So what is the value of that? You can't it's huge,
Hard to
right?
comprehend it. Yeah. Mm-hmm.
It's
You just
huge.
have to
And
get
so
it.
you
Yeah.
got it, but you got to start. If you start when you're 25 or 35, right? Now you've added that time value of money, right? That time has created this compounding effect of leverage to get you where you want to go. And you're going to be able to benefit from it in the short term to leverage all the things you need to do to be investing for cash flow in the short term. But then when you hit the 65, some of the problems that you're going to have to deal with at that point in time that most people don't deal with until they get there, and then they're really expensive problems to solve, those problems are already the boxes are going to be checked, right? And it's going to save you thousands of money. So, a penny saved is a penny earned, right? Like tens of thousands or hundreds of thousands saved is hundreds of thousands earned, right? Like it's the same thing. And that principle doesn't change. And whole life insurance literally is the only asset that will do that for you. The only one.
I love it. I love it. That has been my journey, and I think there's a lot of people watching that are
Yeah.
also going through that and saying, okay, become your own banker, positive arbitrage, bank on yourself. These
Yeah.
can only take me so far, so to speak. And
Totally.
then they start to realize the drag that it's causing, and then they come across something like
Yeah.
permission to spend, cash flow hacking. To sort of close out here today, how much of the cash flow hacking process would you say is in alignment with this last method here with what Tom Wall says in his book, Permission to Spend, or is there any variance in the preface or the foundation of that stance of
Yeah,
how whole life fits into the whole picture of someone's finances.
yeah, I think the cash flow hacking process just expands out on it. Like I would say the permission to spend idea is a portion of the cash flow hacking process.
Okay.
It's like the end stage of everything, of the cash flow hacking process. The cash flow hacking process starts, it's 5 pillars. It's pillar one is personal growth and expansion, because your money and your business is never going to outpace your own growth, right? And you got to become who you need to become to learn this stuff. Pillar two is debt management, because you got to understand how to utilize debt as a tool, right? And understand where debt is dangerous, right? Debt isn't good or bad. Is it aligned or misaligned? Just like all investments. Pillar number three is savings optimization. We got to make sure that our money is being saved in the most efficient ways possible. Not efficient for this year, but efficient throughout the entirety of your life, and what is the life you're trying to desire, and is your saving strategy in alignment with getting you there faster? Not about, am I going to get a higher rate of return this year, but is it going to get you where you want to go faster? And then pillar four is aligned investing, and that's where the investor DNA stuff comes in. And if you look at pillar one and are you growing, are you becoming who you need to become? Well, now you look at pillar four, and it's a process to get there. This isn't something that you just, bang, you arrive. It's you go through this process of growing and changing. And like, you've been doing this for 7 years. I've been doing this for, over 15 now. And it's like, I'm wildly different than I was when I started. My growth, my capacity, my intellect, my network, everything is expanded, right? I've become somebody different, right? But because we implement these strategies long term, we always talk about the compounding of money. What about the compounding of people? What about the compounding of you? What about the compounding of your abilities and your ability to actually go and do this stuff? That's what this is all about. And so that's where pillar four is. And then pillar five is the other thing, which is where Tom Wall's stuff comes in, right? Which is, making sure that tax and estate planning and retirement distributions and all this stuff, and eliminating the sequence of return risk. This is the distribution phase. Most financial strategies and advice are like, how do we get you to retirement with enough money? They don't have a distribution plan. So my mindset and what we try to teach is think in terms of cash flow from now until the day you die, and the legacy you want to leave, and the heritage you want to leave, and all these different things. Your plan needs to incorporate from right now the life you want to live until the transition plan into the next life. You know what I mean? And what you want your life to be about. And I think anything but that is selling yourself short.
Absolutely. We're going to have to do a part 2 on the cash flow hacking process for
Let's
sure. But today was really helpful. I want to thank you for your time. And those of you that are with us still listening, please visit the Life 180 YouTube channel. Check out Chris and his work. We actually are in partnership together. And quick final announcement is Chris is going to be hosting a live event August 21st to the 23rd, hosted by Life 180. And it is an event for business owners, not just people in the life insurance space, but those that are looking to grow, those that are looking to have a transformational experience around how they view wealth and really going through that cash flow hacking process. So I'm excited to be there. I've been asked to be a speaker by you, which is an honor. And I'm excited to bring the heat and to serve at the highest level. So again, those of you that are interested in that, visit his YouTube channel. I'll have links below in the description for the event, and also his YouTube channel and some of the work that we're doing together. Thank you for your time.
Thanks, man.